Okay.
Today's lesson is on Social Security and Medicare. As the reading says on page 28, the largest tax deducted from gross income is federal income tax. So we're going to look at how it's broken down. Now, if you look at it, the income tax that the federal government takes, depends on how much money you make. The more money you make, the higher the tax rate. So, for example, if you make between $0 and $9,000, they tax you at 10%. But then if you make anything over $406,000, you get taxed at a rate of 39.6%. So while you're going through this, just look at the different tax rates, and again, the more income you make, the higher tax you pay. Some interesting facts about this, besides the federal income tax, is talking about Social Security. So Social Security is what we're going to look at next. Social Security is a social insurance program consisting of retirement, disabled, and survivors benefits. So some students actually receive, at any age, you can receive Social Security if there is a disability and you can't work, for example. Currently, anyone born after 1960 can receive Social Security starting at age 67. This means that you're going to get some money, not a lot, that the government is going to give you when you turn that age and until you die. The next term you should be familiar with is Medicare and Medicaid. We'll talk about the difference. Medicare is a federal program that provides health coverage if you're 65 or older or have a severe disability, no matter your income. Medicaid is a program that is for very low income people. Okay, so obviously they're not free and they're taxed at different rates. So in 2014, the employee portion of Social Security tax was 6.2% of your gross pay, meaning your overall pay. And then an additional 1.45% of your gross pay to pay for Medicare. And again, you will see those benefits when you reach a certain age. The next term we're going to look at is page 33. We're going to look at investing and saving. There's different terms that you need to be familiar with, so we're going to go through some of them, and then we'll look at specific examples of these. So as we learned about in our economics unit, financial institutions are just money-related services, often known as banks. An interest is a fee received or paid for for the use of money. So you get an interest on deposit by putting money in a savings account, but then if you take a loan from a bank, you have to pay an interest as well. A term that you need to be familiar with is invest, which means you're committing money to gain a profit or an interest. Some other terms you should be familiar with is the principal, which means amount of money originally invested, and then risk, the possibility of financial loss or physical harm. All right, so now we're going to flip to page 36, and we're going to look at different concepts. So the first one is a savings account. So many people have savings accounts where you leave money in. It's different than a checking account because a checking account, you can use your debit card or write a check, and the money goes directly out of the checking account. In a savings account, you can't do that. People put money in there for usually short terms, and it gets very little interest, but it's also a safe investment because your money is insured up to $250,000 for any savings account you have. So for example, if the bank burns down, for example, and you have $20,000, that money is protected. Another term is certificate of deposit. All this is saying is that CDs, you put money, X amount of money, like $10,000 in for a certain amount of time, and you get, let's say you put $10,000 in for 2 years, you'll get $10,070 back. So you'll get more than a savings account, but it's a commitment for a certain amount of years. If you withdraw from that, then there will be a penalty if you don't go in for the whole 2 years. All right, the next term you should be familiar with is money market accounts. These are interest-earning accounts that usually pay a higher interest than a savings account and usually requires a larger deposit. Again, very small interest, but probably more than a savings account. So it's a very low risk. Bonds are essentially an IOU. So usually the government can ask for a bond. So for example, you can give Uncle Sam, let's say $70, and in 10 years, you can get $75 back. So again, it's a commitment of a certain amount of time, and that you'll receive interest by giving the government or a company X amount of dollars, then you can get additional money at a certain time. Again, this is a medium risk. Unlike bank savings accounts, bonds aren't insured. All right, something some of you are familiar with is stocks, which we've talked about in class. Stocks represent a fractional ownership in a company. Traditionally, they pay higher average returns than most other investments. However, they're also volatile, meaning they can go up or down. So therefore, you want to look at it as a long-term investment, meaning that you're going to keep your money in there for a certain amount of years, not days, not weeks, not months. As it says here, this is a medium to high risk, depending on the company, depending on how much money you have in there. But again, you own a part of a company, so you could own a part of Amazon or Apple or Facebook. Next term is mutual funds. It's a professionally managed investment with money pooled from shareholders to buy a collection of stocks or bonds of various corporations. Shareholders can elect to take the money earned, pay it as dividends quarterly, or reinvest it to buy more shares. Again, this is a low to high risk depending on the investment, what mutual funds you have as well. We can stop there.